Hello friends, last week in my video I categorically told you that fears about a 2020 March-like meltdown in the markets thanks to COVID were pretty premature and statistical weight of evidence did not support a crash theory. And look how the market showed resilience. How will the first week of January be for traders? In this video, I present to you statistical evidence as again for the thoughtful, planning and savvy trader so that you can take better informed decisions in the new year. Let's dive right in, and on your screen right now is the market roundup window which tells us that the rally was fueled by banking, which outperformed the broader Nifty 50, and the US dollar index, which fell, and I've told you many a times, it's positive for emerging markets, including India, because imported inflation is lower, was partly to be attributed for the bullishness. Oil and gas fell in spite of the fact that the dollar was weak, and I've been telling you that this was nothing but a cyclical demand-based up move in the recent weeks. And I've been debunking the super cycle theory in energy. Gold and silver put up another week of gains, and gold buffs are having a good time here. The US dollar versus the Indian rupee was flat. Indian 10-year benchmark bond yields went up by 1 basis point, and the NSE gained a little under 4% in market capitalization. Do remember, last week we lost over 4% and we've almost gained the entire lost ground. MWPL was down, which is routine after expiry, and the US markets were down on a week-on-week basis. On your screen right now is the daily chart of the US Dow Jones Industrial Average, where the 50-day moving average still remains above the 200-day moving average. And what we are seeing is that it logged 2 declining days out of 5 last week. And the decline on Wednesday was particularly vicious, which is why the Dow Jones Industrial Average has logged net losses. And the 33,272 level remains a litmus test for the bulls to overcome. The Nasdaq 100 index, which is directly responsible for the outlook on Indian technology stocks, has witnessed 2 winning days out of 5 days last week. But the death cross remains in place. The 50-day average is below the 200-day average, which is why tech stocks in India are underperforming. The broadest of them all, the S&P 500, still remains below the 3,905 levels, which I have been advocating as a trend determining threshold. Only above 3905 will you basically see semblance of sustainable strength coming in the near term. Now coming back to our domestic markets, the MWPL has routinely fallen after expiry, but it's 1 basis point lower than what we saw in the November expiry. Not really earth-shaking. This could be attributed to the year-end festive season when demand normally is seen lower. We'll monitor this, and this is a metric that I post on my social media account every day. Do stay in touch with me, especially on my Telegram channel where the most of our research is put up. Now for the stock and index futures turnover, which is a total of the entire week, and it's a 20-week look-back bias. Individual stock futures turnover is almost kissing the upper band of the 20-week period. And the index turnover is also in the upper end of the range in the 20-week period. Although the index turnover in futures is marginally lower, but it's the stocks that gained all the limelight. This basically tells me that there was a lot of short covering ahead of the expiry of the December series, and which is what is explaining the jump in turnover. Now for the advanced decline ratio, friends, which has jumped to the period high at 2.54. And remember, this is the average of all 5 trading sessions in a week. We've never seen a 2.5 advance decline ratio of a weekly average. Will this be sustainable? To me, frankly, empirical but statistical weight of evidence seems to point that these high advanced decline ratio levels have not sustained for long. So, this is purely due to short covering coming in the expiry week of the December futures series. This kind of gung-hoism typically tends to cool down after a while. This again is something that I put up on my social media accounts every day. Let's now see the basis. Basis is nothing but the premium or discount to cash enjoyed by the futures, and here both the Nifty and the Bank Nifty basis has gone up. No big deal, no surprises there. This is the beginning of the January series. Traders have 4 full weeks to play around with, which is why they are willing to pay a higher premium. As long as the basis is not inverted, which means trading at a discount to cash, bulls still have a fighting chance. They still have the upper hand. This is again a metric, something that I put up on my social media accounts. Now for impetus, something that I started sharing with you about 7 quarters ago. It's an exclusive in-house indicator you won't find anywhere on the internet. Impetus has actually fallen for both the indices in spite of the fact that the indices logged gains. What does it tell you? That the up move lacked conviction. Do remember, this was year-end. Traders, especially retail guys, tend to back off. So it was more of short covering that was responsible for the market going up, which is why the impetus is down. I would want prices and the impetus to rise in tandem together before I can call a fresh buy. So let's wait and watch there. Now for the LWTD, which has been extremely prescient in calling the market direction in advance. Now the LWTD has risen sharply, and so has the Nifty percentage gain loss line. That tells me that there is a likelihood of improved buying support on declines in the first week of January 2023. This is again a metric that I post on a daily chart basis. This, what you're seeing on your screen, is a weekly chart. The daily chart is posted on my social media account. Now for the footprint of the 4 market participants, starting with the FIIs, they've gone net long in index futures where they were short last week, and they've increased their net long positions in stock futures as well. So they seem to be gung-ho. DIIs have increased their short positions in index futures and reduced their short positions in individual stock futures. DIIs invariably tend to always remain short because they are buying in cash and hedging in futures, which is a neutral kind of a strategy. Where prop traders are concerned, they've dropped their individual stock long positions sharply. And a part of the reason is the expiry of the December futures series. And they've also reduced their short positions in index futures. So what they've done, if they've reduced their longs in stocks, they've reduced their shorts in indices, which means they are taking a very hedged outlook here. Where retail traders are concerned, they've done all the heavy lifting after COVID-based lockdowns were imposed, and they too have reduced their net long positions in indices and individual stocks. No surprises because of the festive year-end season, holiday season. How they pick up the gauntlet from the first week of January will decide how much of up move you may be able to see. Now, friends, I come to the 4 index heavyweights which swing the indices with themselves. Starting with the heavyweight biggest boy of them all, Reliance Industries, whose daily chart you're seeing on your screen. The stock has logged 3 winning sessions out of 5 last week and has almost come to kissing distance away from its 25-day exponential moving average, which is a month-long holding on cost. The average, unfortunately, is sloping downwards. So for the bulls to basically get an upper hand, you again come back to the 2618 level. We need to stay above this level for Reliance to boost the Nifty by any significant measure. Do remember the weightage at 11.36% is sizable. The second big boy, HDFC Bank, the highest weighted in Bank Nifty and the second highest weighted in the Nifty 50, has seen two declining sessions out of five. Price is above its 25-day exponential moving average. The average is sloping upwards as well. What we do see is a sustained breakout above the 1,675 levels will propel it in an low resistance area. Now that is something we need to watch out for in the coming week. Infi, the bellwether, one of the bellwether stocks in technology space. Do remember the Nasdaq 100 remains under pressure. So no surprises. Infi's 25-day exponential average continues to fall and the price remains below the 25-day exponential average. So Infi is unlikely to put up any significant support for the Nifty 50. Fourth index heavyweight, the last of them all. Number 4 where weightage in Nifty is concerned, but number 2 weightage in the Bank Nifty, ICICI Bank, the average has started to turn downwards. Now that is a sign of marginal weakness. The price remains below its moving average and look at how it's been unable to close above the average. Even on Friday, it opened near the average and fell downwards. I'm watching the 867 level very keenly. As long as we don't close below this level, bulls might just pause for a breather and push the markets higher. But for any sustained up move, I would want the price to go above the 915 odd levels and stay above that on a closing basis. As long as that's not happening, I'm basically waiting and watching on ICICI Bank. Friends, now I come to the bond market asset class very close to my heart because it helps me trade equities, especially banking stocks, much more profitably. I have been a big votary of watching the 10-year Indian benchmark bond yields, and bond yields have basically risen 1 basis point. But the biggest news of them all is that small saving interest rate coupon rates have been raised significantly. What does it mean? I've explained to you in my Telegram channel in fairly detailed editorials that I have written myself that cost of funds is likely to rise, and that should be worrying equity bulls and bulls of any risky asset class, because bull markets are built on low interest, easy availability of money. So enough money at low interest rates. Now money, easy money, is mother's milk to a bull market. Now that factor is changing. Do you have a blueprint in mind, ready at hand for what you're going to do in a rising interest rate scenario? You'll find all these answers and more in our Telegram channel, where I discuss this at length in many of these editorials that I have written myself. Do take the time out to subscribe to our free Telegram channel. I am not charging anything online for any of the data that I put up here. So laddering is something I have been talking about, and I told you I'm holding my check back. Last week I told you, and as a matter of fact, many weeks I've been telling you I'm holding my check back. All fresh allocations are on hold till I see a crossover of 7.55. On social media on 26 December, I said a lot of our fixed deposit brokers are calling us and telling us, hey Vijay, especially for you, a sweet deal, one-time limited time offer. We'll pay you so much higher fixed deposit interest from so-and-so company. Hurry before the offer ends. I assure you, these offers are going to get stickier. They're going to get getting more often, more frequent, and interest rates are going to climb. And we have a game plan ready for that. We'll keep on sharing details with you, especially on my Telegram channel, as more and more data keeps trickling in. Now, friends, I come to the US dollar index. Extremely critical because all our imported goods and services are billed in dollars, and therefore landed price of these goods and services are determined by the dollar peg. and imported inflation is determined by the dollar peg. The daily chart on your screen of the US dollar index shows that the dollar index has stayed below the 104.51 threshold, which I have been cautioning you since at least 3 weeks now. I told you the probability of going to 102.50 or 103 becomes elevated the longer the dollar index stays below 104.51. The price is below its 25-day exponential moving average, which itself is sloping downwards. Good news for India and other emerging markets because a weak dollar boosts emerging markets. Now let's take a look at the weekly chart. The third bearish candle in a row, and the price is significantly below its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, which tells me that the dollar index might just go lower, which is a positive sign. Friends, last week I advocated a range between 106.64 on the upside and 102.02 on the downside, which held perfectly well. In the coming week, I expect a range between 105.72 on the upside and 101.26 on the downside. Do keep watching the dollar index. Friends, I now come to the Bank Nifty, which was a star of the trading week. It gained 3.16% on a week-on-week basis. And as the daily chart on your screen shows you, it fell on only 2 days out of 5. Friday being a prominent day. Now, the price is above its 25-day exponential moving average, which is flatlining, going sideways. It's still closed above the average. What we want is a sustainable close above the average itself, and the average should be rising, and we could see another bout of short covering. I've explained to you in my Telegram channel as to why short covering rather than fresh buying is pushing the indices higher. Let's take a look at the weekly chart on your screen. It's showing a bullish piercing pattern. That means the bullish candle of the last week has pierced the prior week's bearish candle by more than 50%. The price remains above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. I explained to you what mean reversion theory is. Either the price falls towards the moving average or the price goes sideways and the moving average catches up with the price. That is mean reversion. As long as the price remains above the moving average, the bulls are still A-OK. So the bulls are A-OK. Friends, in the week before last, this index was at number 5 on our statistical beta list, the list of most volatile counters. It rose 2 notches to number 3. Now that's a sign of concern because the more volatile it gets, the more challenging it is for retail traders to take money home. This is something that I have been warning you both in my videos and in my live mint column, that volatility as the year end approaches will be higher because volumes will be lower and the bid and offer spreads, the difference between the buy and the sell order limits will widen, leading to higher volatility. So this is not surprising that the Bank Nifty has risen 2 notches to number 3. Last week, I advocated a range between 43,025 on the upside and 40,300 on the downside, which was overcome on the upside because the intra-week high was 43,498 in spot. I don't think the bulls are complaining because it overshot on the upside. In the coming week, I expect a range between 44,375 on the upside and 41,600 on the downside. I still advocate that my friends trade light because the FIIs haven't really come back in earnest, and it's only after the results of technology companies, which are traditionally the first to announce their quarterly numbers, only after their results are out will volumes pick up sizably. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 1.68% on a week-on-week basis. It fell on only 2 trading sessions out of 5. And as the daily chart on your screen shows us, the price has taken resistance at its 25-day exponential moving average, which itself is sloping downward. So what I would want is that the bulls should keep the Nifty trading above 18,300 on a sustained closing basis and possibly go past the 18,351 level as well. Only then would you actually see confidence to buy a fresh return further. Let's take a look at the weekly chart. Here again, what you're seeing is a bullish piercing pattern. Now, the bulls have managed to basically retrace more than half of the loss of the prior week's bearish candle. Do note how the price has bounced from the 25-week exponential moving average, which is a 6-month holding on cost. Do remember what I told you about mean reversion. The index has come to its 25-week exponential average and jumped. So as long as the bulls keep the Nifty above its average on a weekly chart, I think mean reversion and routine corrections are okay, and the price can resume its upward trajectory provided follow-up buying starts coming in. Now, in the week before last, this index was at number 11 on an in-house statistical beta list, but it fell one notch to number 12. All fine. The lower the volatility, the better it is for a retail trader, but no cause for really bringing the champagne out. It was individual stocks whose volatility rose faster than the Nifty, which is why Nifty fell one notch. It's not that the Nifty was significantly less volatile. Last week, I advocated a range between 18,300 on the upside and 17,300 on the downside will head perfectly well. How perfectly? Because the high was 18,265, which is just 35 points below the resistance level that I advocated. Now, this is the kind of finesse that we are slowly but surely endeavoring to bring forward to put forward to our online family through our statistical trading model, the IBEX. In the coming week, I expect a range between 18,600 on the upside and 17,600 on the downside. Friends, here again, I suggest you continue to trade light, keep your stop losses in place. Like I said, it's only after the technology stocks, technology companies announce their quarterly numbers that volumes will come back to normal. Friends, I now come to the last bit of statistical studies wherein we gauge the risk appetite of the retail traders through the footprint of the turnover that they generate in index and stock futures and options. Remember, if they trade stocks more than futures, stocks more than indices, risk appetite is high. And within the stock space, if they're trading futures more than options, the risk appetite is even more higher. So on your screen right now, what we can see, the sky blue line is basically the stock options turnover. It's down on a week-on-week basis. And the army olive green line is the stock futures turnover. That also is down. What we are seeing is the Nifty futures turnover that has essentially risen a bit and going towards the index options turnover. Remember, this segment, index options, contributes more than 90% of the entire derivatives turnover. So it's extremely critical to watch out for as a statistical, as a savvy and discerning, thoughtful trader. What we have seen is after plunging to its period low on the prior Friday, we are hardly seeing a decline in the index options turnover. That means traders have become risk averse. They are not playing stock futures as much as they are trading index options. That's extreme risk aversion. Now, I'm willing to give them the benefit of the doubt that this was a year-ending week and therefore risk appetite tends to be lower historically. If it does not pick up in spite of rising prices, then maybe we need to relook our strategy. Friends, the statistical part of the video over. I now come to the news segment that I have started sharing with you as to what I would do in the coming week. Now, I would basically start targeting interest rate sensitives, and this is a game plan that I have time and again shared with you on our free Telegram channel. I will target those interest rate sensitive stocks, and I will start to ride out the time decay via options. And I will seek intraday tactical opportunities to go short. What is a tactical strategy versus a strategic strategy? Strategic investments are where you take a longer time frame as your view in remaining in a trade. Where a tactical trade is concerned, you want to get in and get out. So I'm not saying that I'm going to go out there and bet the bank on shorting these stocks. No, I'm saying tactical. It could be, and my tactical trades are 59 minutes and 59 seconds. So I don't wait beyond an hour. And theta decay, I'm completely sold out on that idea. It's been working out so well, and I do expect it to continue working. Also, I will go very easy because it's the beginning of the year and the FIIs have not really come back in earnest. I will be seeking higher yielding fixed income avenues in the sovereign space. I'm a big fan of sovereign 100% government guaranteed investments where my capital is guaranteed by the President of India. I don't want to risk my capital. The only risk that I take with it is extreme leverage trading in the futures and options space on the exchanges. So that is one extreme leverage, extreme risk. And on the other hand, it's balanced by sovereign investments where there's little or no risk at all. That strikes a kind of a balance for us where risk reward is concerned on the Jensen's measure, on the Traynor ratio, and on the efficiency frontier where a rotation of our capital is concerned. We are big fans of statistical trading models, so we'd like to basically keep it simple. So I will of course share these instruments as and when I come across where the yield particularly is crossing 7.75 or if at all we strike lucky, maybe even go past the 8% threshold. That would be too mouth-watering to let go of in the calendar year 2023. Of course, I'll keep hunting for more and more trading ideas in the higher risk space. But for this particular coming week, I'll be focusing on theta decay and finding mouth-watering fixed income, high yielding sovereign investments. Friends, I now come to the most popular segment of this video for statistically minded traders, wherein I give you 5 stocks that gain the most amount in statistical beta and impetus. So you take small exposure on Monday and wait for large price moves, and 5 stocks that lost the most amount of impetus, wherein you take big exposure, wait for small price moves. This is for scalpers. This list is valid only for Monday, Tuesday through Friday. I update this list only on my Telegram channel. It's a free channel. Do feel free to subscribe to it. So the statistical beta gainers, the impetus gainers list is led by Jindal Steel number 1, number 2 TVS Motor, number 3 JSW Steel, number 4 Motherson Sumi, number 5 Hind Unilever. Impetus losers list for Monday led by Infosys, number 2 Page Industries, number 3 TCS, number 4 Polycab, and number 5 OFSS. Friends, before I draw this video to a close and I say goodbye to you, a humble reminder to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the year 2023, I plan to bring you a lot more content, share a lot of our exclusive in-house statistical indicators that you will not find on the internet. Do keep your feedback coming via the comment section and share my videos with like-minded savvy traders like yourselves. I wish you have a very, very happy and a profitable new year 2023. Till we meet again in the next, this is Vijay Bhambwani signing off for now from this video. Bye-bye. Thank you.